We are having one of the warmest winters on record, and we're feeling some of that heat in the markets. Equity rallies, uncertainty still looming around the Fed, the deterioration of the credit cycle, and of course, Congress has their hands tied with debt. So we're going to put a little light on these hot topics right here on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Connor O'Brien, the CEO and president of O-Shares, joins us today for this great conversation. Connor, great to see you here. We've got a lot to get to, you and me, Connor. So first of all, welcome. I wanted to start with the Fed. We're looking at the news that came out from Jay Powell in his congressional testimony, and suffice it to say, he is really kind of signaling that perhaps we're in for a bit of a longer tightening cycle than maybe we had heard from him at the last meeting. What are you getting from what Jay Powell is saying here?
Well, the Fed's got a tough job. There's so many trillions of dollars pumped into the economy, QE, then the COVID relief package, then the Inflation Reduction Act, all adding up to something over 10 trillion.
Yeah, and it's interesting because, obviously we've been talking about the jobs data, this very tight labor market, and even with inflation coming down a little bit, and then we had this rally in equities, which maybe was a little bit more hope than reality. But when you look at what the Fed has to do you think they're going to continue to tighten here more than maybe the original 25 bips at the next two meetings than we were expecting as of just a couple of hours ago?
I would expect them to kind of go steady, not necessarily just crank up the rates. But if you look at what happened with inflation, it was just over 9. It's now just around 6 and a bit. But wage inflation did not come down. It's still hovering in that 6% area. And that's the stickiest part of inflation. And I bet that's what the Fed's paying close attention to.
Yeah, imagine so. And also, you can't not pay attention to the fact that when you're looking at that yield curve inversion, which has been going on for quite some time, when Powell was making his comments, the 2-year exceeded the 10-year by a full percentage point, which hasn't happened since 1981, which at this point really looks like it could signal a recession is on the horizon. And there's certainly been some questions about the R word. What are your thoughts on that?
I think the odds are higher with the Fed needing to move yields up, rates up. And we don't see it in the jobs number yet. But think about this. I mean, how many months does it usually take for Fed action to actually really impact jobs in the economy? It's 12 to 24 months. It's not 12 minutes or 12 days.
Right, exactly. You're right. I mean, it's a little bit more of a kind of a lag that we have to pay attention to what's been going on for the last couple of months, not just the last couple of weeks. So maybe that brings us to the next part. And I want to talk about this with you as well. Obviously, since last October of 2022, the equity markets have been in a bit of a rallying mode. And as I said, some people are saying it's maybe hope over reality, although when Powell was making these very hawkish comments, the market did decline pretty significantly. What do you think has been sustaining the markets, the equity markets, up until that point when Powell made these comments?
I think it was initially hoped that the increase in rates by the Fed was going to basically level off at around this current level, and then we'd see valuation expansion continue. We'd see earnings growth continue. And I think it was a bit premature, but it was a relief rally. I think we're in a trading range maybe through the rest of this year as we see what the Fed does, what earnings do, what the economy does, what the geopolitical situation does. So many things that are moving, probably within a trading range. And I think it's very difficult to stay uninvested in equities at this time because we all know in 2009, it was a terrible mistake to stay uninvested waiting for things to get better because the people who did that left 50 to 100% returns on the table.
Exactly. What do they say? Time in the market, not timing the market. That's pretty much the phrase that has been coined in my brain for such a long time now. What do you think about opportunities, though, within equities, Connor? Do you see opportunities right now in the U.S.? What about outside the U.S.? Because one of the messages in focus that our chief investment office has here at UBS is to diversify beyond the United States, look at international and EM.
Yeah, so a little diversification now, makes a bit more sense than in the past because you've got dollar strength, and at some point the dollar is going to level off, but the Fed's going to be supportive of the dollar indirectly just through their policies. Small cap's an interesting space to be because there's less sensitivity to rate moves and the dollar moves. But I do think that China's reopening with ever so great difficulty, And emerging markets more broadly, well, I'm not so sure. Dollar strength's not good for them. So a little bit of Europe, a little bit of China. Careful about emerging markets.
Terrific. Let's talk about allocation in one's portfolio. Obviously, we were just talking about this, and you're not the first person I've had this conversation with, where that traditional 60-40 portfolio allocation is not really standing up to the markets that we're currently in this particular environment. What are you talking about with your clients?
Well, there was sort of that declaration 60-40 is dead. That was about a year ago that people were coming out with that, maybe even more. And it was probably a good thing to reduce the allocation fixed income back then. But now we got yields across the board at 4, 5, 6% in investment grade um, assets. And so I think actually the people that took money out of fixed income might be considering going back into it a little bit. I'd stay within the middle of the curve and stay investment grade and get that 4, 5, 6% over the next 1, 2, maybe it's 3 years before we start to see yields come down a bit. So we've got a better future for fixed income than I would say, last 10 years.
Yeah.
And I'd be very careful, stay liquid, because you just never know when we're going to have another liquidity problem. So I would stay liquid with the fixed income assets.
Yeah, that was a big topic of conversation before the pandemic. We were in a bit of a liquidity crisis, and that doesn't seem to be the issue here. But certainly that brings up questions about the credit cycle. Obviously, availability is tight with rates where they are, and if the Fed does continue to raise rates more than anticipated, the credit cycle could be in for a bit of a deterioration. Where are your thoughts on where we are with that credit cycle right now, Connor?
I think we're sitting on the fence here. You got two sides of the story, and I think nobody's really winning in terms of spreads widening dramatically. Not really seeing that yet. I think it's at a tipping point, and it really could. I think it's risky. I think it just could hurt if people get too extended on credit, on junk, high yield. That liquidity is massive in the market right now, but if it actually gets pulled in by the Fed and things go illiquid, spreads will widen even before a recession, if there is one, it would hit. I would be very cautious about being overweight anything risky in the high yield space.
Yeah, that's the same here at UBS. Our CIO is saying for income, look at IG corporates, and certainly anything that's investment grade is kind of where you want to be putting your money here today.
And be careful with duration. Don't get too far out there. If the yield keeps getting pushed up, if inflation's really, really stubborn, duration could hurt.
Yeah, exactly. Thanks, Connor. Really quickly, we've got a debt ceiling looming here in the U.S. and not that we're talking about policy at this point. It's more about the markets and the economy. Not like there's not enough already to maybe spook the markets as we go over the next few months. But if for some reason the U.S. government does not figure out a way to manage this before we hit the debt ceiling, what are those implications looking like for the markets, for the economy later this year?
Well, it would be a shock, right? But I think it's all politics and everybody playing a game, and nobody wants to be responsible for blowing it. And so they're using it for leverage as long as they can. But ultimately, nobody wants to be, whether red or blue, nobody wants to be the one that caused the debt ceiling to fail to be moved up when necessary. So I think there'll be a lot of brinksmanship, and we'll get, to the 11th hour or more. The markets might get a little bit nervous for a little while. I think it's very, very unlikely that we'll see a debt ceiling problem actually materialize.
Right. Yeah, with $31.4 trillion in debt that we have to figure out before September-ish. I guess we'll know more in the next coming week when that's going to be. But yeah, I tend to agree with you that nobody wants to be in that situation.
They could fight it. They might fight over it for months as we head into this midterm and everything else. It could just be a battle down to the wire. But I think when they get to that wire, they're going to both blink.
Yeah, there may be some posturing. We've got a mixed Congress, of course, and so Republicans here and the Democrats here. But yeah, I hope you're right, and my fingers are crossed for everybody. Let me ask you, Connor, before we wrap up, what's a takeaway here that you want to leave with our viewers who are market investors or thinking about getting in here? What's the takeaway that you want them to keep in their brains as they walk away from this conversation today?
I would think, yeah, asset mix is one thing. Stay invested is another thing. Focus on quality. U.S. large cap, small cap, quality. Money flows are going into dividend strategies, so that's an interesting place to look at. And I think it's just really important to tell clients that the best way to deal with inflation is to stay invested in inflation-resistant investments. Sitting in cash is almost the worst thing to do during a period of inflation. When the economy pulls back. Okay, it pulls back temporarily, but if you lose to inflation, you've lost permanently. Stay fully invested, maybe take the risk down by reeling in the duration, stay in investment grade on the fixed income, stay high quality on the equities.
Terrific. Connor, thanks very much, my friend. It was great to see you. Next time, we'd love to get you here in the studio with us. Connor O'Brien, CEO and President of O-Shares. And for more information on anything we spoke about today from us, our Chief Investment Officer, or any of our other partners, make sure to visit ubs.com/views. That is our insights page for UBS. Plus, you can follow us on social media, LinkedIn, Facebook, Instagram, Twitter. Plus, you can check out our past trending episodes on demand. And as always, if you have any questions about your own portfolio, make sure to speak with the financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great rest of your day. And remember to keep your eyes on what's trending. See you soon.